Mr. Basi, we can see your face. But we can't hear you. We can't hear you. We can see your face, but we can't hear you. Mm.
Demola, you're not the only one. I don't think Mr. Wasiu is even on this call. Let me call him.
Maybe the person wey dey bring the rice, he don't pay too much now. Why they even tell me about the rice before they bring them?
Hello, guys. So I've tried to reach out to him twice. I've called him, but his line is not. He's not picking. So I don't know if we can maybe wait for some minutes. Let's say 15 minutes and see. Or maybe he's having network issues because I don't know. It feels like throughout today, most of the classes have been having network issues. So if you can wait by like till 5:40, then if he doesn't reach out again during that time, if I call him and he doesn't reach out, I think we can just log off, and then if it comes between that time to 7 p.m., we can come back here. So let's just give him 15 minutes. Thank you.
Noted.
Please, Temi, can you notify us through the group WhatsApp when he comes online, please?
So Mr. Wasiu called me back. He said he's been trying to connect and there is network. So we should just give him some time. He's trying to connect now again.
Hello,
Hello, sir. We can hear you.
can you hear me now? Thank God. Yeah. Where do we stop? Stop on it. It's at two. Is that
We
not
did
so?
cash flow.
Eh?
We solved the cash flow, two cash flow.
That is, it's at two now.
Yes, sir. Which is two, yeah.
Let's quickly look into three. It's at three. It's at 17 and it's at 13. Let me just do the summary, then the calculation can take place and be able to do other things. I'm coming.
Hello, Mr. Wasi, are you saying anything?
I'm here. I'm coming. I'm trying to come up with
Okay.
something.
Okay.
Yeah, that's why it's very sweet.
Can you all see the screen?
Yes, sir.
Okay. We've discussed if someone already, where we talk of the statement of financial performance. That one has been done already. We discussed if SAT2, which is the cash flow statement. Everything relating to that has already been what also discussed. Now, it's SAT3. Are you with me?
Yes,
That is
sir.
accounting policy change in accounting estimate and error, version of error. Now, we don't need to waste much of our time on this one. What is it all about? According to the accounting statement, if you can still remember, if you're preparing the financial statement, I told you there is a particular statement that we call accounting policy, statement of accounting policy. Simply means you need to know what are the accounting methods, the policy of the organization, and what are the necessary information to be disclosed when it comes to preparation of financial statements. When we talk of accounting policy, the policy of the company is to pick a particular accounting method in preparing their financial statement. First aspect of it is, are you using cash basis or accrual basis to prepare your financial account? That one is one of the policy you are meant to adopt, because we have different methods of accounting accounting basis. In terms of that, if you are using cash basis, you need to notify the what? Notify the public that this is what you have used to prepare your financial statement. Now, if there is any correction that you have taken on board in terms of the estimate you have put in place, you also need to state that. Now, looking at it from the accounting method, which also form part of your policy, what depreciation method have you taken into consideration? Have you used what we call straight line method, reducing balance method, sum of the year digits, or the weighted average? Anyone you have adopted, you also need to tell us. And what are the accounting what do we call this? The depreciation rates you have adopted. All these are meant to be disclosed. In terms of the exchange rate, you also need to explain to us whether you have adopted the exchange rate in preparing your financial statement. All this needs to be stated in the statement of accounting policy. Now, let's see what the note we're having here is talking about, explaining to us to have what consider. All this has to do with what? Preparation of financial statement. In terms of your decision method, in terms of your inventory management, what method have you chosen? Have you chosen to prepare to value your inventory? All these are meant to be stated clearly in your statement of in the statement of accounting policy. Now let's go. I've explained it in a summary, but let's see what the note is talking about. The standard is designed to set up the criteria for selecting and changing of accounting policy, together with the accounting treatment and disclose of the change in accounting policy, if there's any changes that have taken place. Changes in accounting estimate and correction of error. Any error that you think you have adjusted prior to last year and the current year, you also need to state that in case they are going through your books, they can be able to explain those things in details. Now, a part of it says what? Accounting policy are the specific principle, basis, convention, rules, and practice applied by the entity in preparing and presenting financial statements. It doesn't differ from what we have explained so far. Now, what we are looking at here is that what are the principles you have adopted, what accounting basis have you picked, what convention, the rules and regulations you have adopted in preparing your financial statement. That is what accounting policy is all about. In terms of what? Changing in what? Accounting estimate. It is an adjustment of what? Carrying amount of an asset or liability. When there is a change in liability, taking for instance, maybe the estimated year of the asset said to be what? 10 years. But maybe you have adjusted some things in the what? In the financial, in your accounting policy. In that process, maybe it has now reduced the estimated year of the asset or increased the estimated year of the asset. You need to state that. That is what we mean by what? Correction of error or adjustment of what? Carrying amount of assets and liabilities. End of the year, a prior year adjustment, correction of errors. Maybe mistakenly you omitted some things in the previous year. You now look at it and you now try to bring it on board. You also need to explain that. That is what we refer to as what? Prior year error correction. All these are what relates to what? Change statement of accounting what? Policy. Now, looking at it in terms of what? Changing of accounting policy, a change from the base of accounting to another basis is change in accounting what? Policy, which is the thing of what we have been talking about. The treatment and recognition of transactions. How did you mean to recognize your transaction on your accounting basis? Is it on cash basis or accrual basis? You also need to explain that. That is changing accounting what? Policy. Maybe previously you were using cash basis, then you want to change. You also need to narrate it in your what? Accounting policy. That from so year to so year, this is what you have been using to prepare your financial statement. But presently, this is what you have what? Picked to prepare your financial statement. All these are what we refer to change in accounting policy. Now, what are the things to be disclosed? Disclosure. Information to be disclosed when it comes to accounting policy. Now, when initial application of Ipsas is made and as effects on current, prior or future period, the title of the standard needs to be stated. When applicable, an event of transaction provision needs to be stated. The nature of the change in accounting policy needs to be explained. When applicable, a description of transaction provision, all these are meant to be clearly stated. Now, we don't need to waste much time on all these ones. Something you can try to understand that when you talk of accounting policy, it has to do with what? The disclosure of information that's based on the change in accounting policy or the accounting method you have adopted, the principle you have adopted. All these are made to be what? Stated. That is what it is all about. Mr. Idris has discussed Ipsas 4 with you, which is what? Foreign exchange rate. I don't need to discuss that now. What? Hello?
Nope. No, he has not discussed it.
No, he hasn't.
No, he has not
Maybe he's
discussed
going
it with
to,
us.
but he hasn't
Maybe
done
he's
that
going
right now.
Foreign exchange rate, are you sure?
I am very sure. I'm extremely sure.
Foreign exchange rate. Effect of foreign exchange rate on financial statements.
No, we haven't treated that. I don't even think we haven't treated any Ipsa with Mr. Idris.
He has not discussed any Ipsas with you.
Nah. Not that I am aware of.
I don't understand what you're saying, Jao, but no problem.
Sir, we have not done that foreign exchange rate. We haven't done it.
Okay. But that one is not even what priority now. Let me look at those ones that are priority.
Okay.
Because exchange rate is what?
Okay.
When we look at the exchange rate, we are talking of the rate at which we exchange a particular currency with another what currency. Are you with me? Hello?
Yes, sir, we can hear you. We can hear you. We're still with you.
I'm doing online class. Taking 2 hours today. I will call you back. Okay. Nevertheless, we don't have much to discuss on this, but I will discuss it when it is necessary. But those ones that are very, very cogent, that are very, very necessary for treatment of transactions, I need to discuss those ones. take note of that what Ipsas for. No problem. I will discuss that. Okay. If you look at it, we are meant to deal with inventory. Is that clear? Hello?
Hello, sir.
Yeah. We are meant to deal with inventory. That one is very compulsory. Aside that, we're also meant to look at it from contracts. Contracts. Are you with me?
Yes, sir.
Now, those who passes through the foundation, they might have little knowledge about it, which is Ipsas 11. Ipsas 11 is all about construction contracts. Ipsas 11 is all about what? Construction contract, which has to do with what? Contract account. It has to do with what? Contract account. The Ipsas 11, the objective of Ipsas 11 is all about revenue recognition and treatment of costs in contracts. Revenue recognition and treatment of costs in contracts. That is what Ipsas 11 is all about. Revenue recognition, as in contract revenue recognition, and recognition of what? Or the treatment of what? Of costs associated to what? To contract. Let's see what the book. The objective of this standard is describe the accounting treatment of costs and revenue associated with contracts, construction contracts. Construction contract simply means a long-term project that is durable in nature. Long-term project that is durable in nature. Are you with me? As a result of that, you are meant to have the way you are meant to recognize your revenue and how you are meant to recognize your expenditure.
Sorry, please, can the person mute?
What do you say?
Please, who's speaking? Can you mute? Somebody is talking, Mr. Wasiu, apart from you.
I don't know the person.
Okay.
Let me
Yes,
see.
I've told the person to mute.
Okay, let's see. Good. Who is Christopher? Is the only person that has not been muted. No problem. Let's go. Now, let's now look at it one after the other in terms of the what? The definitions of terminologies relating to this, which you need to have idea of. The first one there is what? Contract, construction contract. What is it all about? It is a contract or a similar binding arrangement specifically negotiated for the construction of an asset or combine of assets that are closely related or interdependent in terms of their design, technology, functions of their. Who is this person now? Now, looking at it from another dimension, we have what we call contractor. This is an entity, a party, an entity or a party that performs the construction work. That is the person we call contractor. While contractee is the person that gave out the job, the work, the contract to that third party. We have cost plus or cost-based contract. This is a what? A construction contract which the contractor is reimbursed for allowable and otherwise divine costs in case of the commercially based contract, an additional percentage of this cost or a fixed amount. All this one might be English that you are not clear with. Let me explain. When we talk of contract cost, the amount quoted by the contractor for the contract for the construction work to be carried out, plus certain percentage. After estimating the total cost, it added some amount that will serve as a profit to such a person, or based on the other likely expenses to be incurred. That is additional percentage of the cost or a fee. Is that one cleared? Fixed price contract, that is the value of the contract quoted for the construction work by the contractee based on the agreement between the two parties. Now let's see what it's saying on the note here. Fixed price contract is the construction contract in which the contractor agrees to a fixed contract price or a fixed rate per unit of output, which in some cases subject to cost escalation clause. Now, we're looking at it from what is the cost you are incurring. How much are you quoting for me? We need to overlook of the two and say that, okay, this is the cost, this is the value you have quoted. Then the difference between the cost and that value, that is what we refer to as what? Profit. If you can remember those who passed through me in foundation, when we discuss contract account, we have what we call value of contract, value of work certified, cost of work certified. The difference between the cost of work certified and the value of work certified will give you notional profit. The same thing applicable to this one. We have what we call the contract fee, which is the value attached to the contract. Why the cost of the work done is the cost you have incurred in the process of carrying out that particular what assignment. The difference between that will give you your what profit element. On the second phase of this, we have the contract revenue. How do we analyze this? Listing here. That is the amount you are meant to generate on that particular contract. The initial amount of revenue agreed in the contract and the variation in contract work claims incentive payment to the extent that it is probably that they will result in revenue and they are capable of being reliably measured. Now, what we are saying is this. The initial amount you have quoted for the work is the revenue. Any forms of variation, if there is an agreement in the process that if there is a change in price, in the course of doing this particular what contract, I meant to increase the amount of what given to you initially. That simply means that you are meant to have additional what variation in the contract fee in the future, not at present. In that scenario, that one will be part of the revenue you are going to recognize. That is what they are telling you. That is the initial amount plus the variation value. This will be based on what? On an agreement. That if it happened this way, this is what we are going to do. That is what we will pass as what? The revenue. The amount you have quoted, the initial amount you have agreed that you are going to collect for the work you wanted to do. And in the process, you notice that the changes. And the agreement you signed initially says that if there is a variation in the price of what? Of those material in the market, that is subject to what? To review. In that scenario, additional money collected will be added as part of what? Revenue. That is what it means. Now, how do we go with contract what cost? Now, for contract cost, which is part of what we have explained before, we just want to analyze it. We have what we call cost that relates directly to the specific contract. That is, such as what? Material, labor cost, all those ones, they are examples of what we refer to as what? Direct cost. Now, looking at it from another dimension, costs that are attributable to contract activity in general and can be allocated to the contract on systematic and rational basis. That is, any part of cost you incur on the activities you are doing, that they can allocate it to any area in that contract, it is referred to as what? The contract what? Cost. If you can remember, we have what we call sublet. You subcontractor. You gave up part of the job you are doing to subcontractor. You are the one that gave the work to, but part of the work is also being given to somebody to do. Taking, for instance, maybe you take the agreement is to build the house and also put in place all the electrical works. Then you now give out the electrical work to somebody to do. That is what we call subcontract. It is directly related to that work, to that business or contract. How do we now recognize that? Such other costs are specifically chargeable to customer under terms of what? Contract is also referred to as what? Cost. Anything you incur in the course of carrying out that particular what? Contract construction work is referred to as what? Contract cost. Now, let's now look at it. Recognition of contract revenue and expenses. How do we recognize it? I don't read all this. You're supposed to go and read all these things yourself. For person not do now. Now English person go to school. Okay. Oh. Shall we? I've analyzed it, but let's read it and see what it's talking about, whether it's different from what we have talked about or not. When the outcome of a construction contract can be estimated reliably, contract revenue and contract costs associated with construction contract should be recognized as revenue and expenses relatively by reference to the stage of the completion of the contract activity at the report stage. Now, in a simple analysis, construction work, contract has a what? It's stages. Construction contract has what? Stages. The stages where you are meant to recognize the revenue relating to that stage and also recognize the cost relating to that stage, through which you can determine the notional profit. Now, listen here. In the case of a fixed price contract, the outcome of the construction contract can be estimated reliably when all the following conditions are satisfied. One, total contract revenue, if any, can be measured reliably. That is, you can measure that amount to recognize that. B, it is probable that the economic benefit or service potential associated with the contract will be flow to the entity. The economic benefit there is what? The profit element. What are you enjoying from that? From the cost and from the revenue? Then the element of that is what we refer as what? Profit. Both the contract cost to complete the contract and the stage of the contract completion at the report stage can be measured reliably. Now, what we are saying is this: at each stage of the product, at each stage of the contract, you are meant to report the cost, report the revenue, and determine the economic benefit to the contractor. The economic benefit to the contractor is the notional profit to be reported at each stage of the work. The economic benefit is referred to as the notional profit to be reported. Notional profit is the profit to be reported at each stage of the contract. The contract cost attributable to contract can be directly identified and measured so that actual contract costs incurred can be compared with the prior estimate. That is, what budget you have done in the past, compare with your actual cost and see whether there is a variance or not. In the case of a cost plus cost-based contract, the outcome of the contract cost can be estimated reliably when all the following conditions are met. What we are saying is this: under the cost plus, there is element of profit you have quoted as a result of variation that might end up in the future. You have added some things. Taking, for instance, you have given you want somebody to come and help you to paint your house. The painter came around and quote the price for you. In the process, you try to do your own votes, your own verification, and discover that there is a difference between what the person quoted for you and what you get in the market. In the process, the person meant to put in place what we call what? Carriage inward to the system. Because he has quoted that, okay, well, I'm moving this particular product from where I purchased it to where I wanted to use it. I'm meant to pay transport fee. All this can bring on board what we call likely variation in cost. Now, let's move forward and see what this one is saying. It said, Roman figure 1, it is possible that the economic benefit or service potential associated with the contract will flow to the entity, that is the contractor. Economic benefit, the profits. That's number 1. 2, contract costs attributable to the contract, whether or not specifically reimbursed, can be clearly identified and measured when the outcome of a construction contract cannot be estimated. You are not being reimbursed, but you are going to take it as part of what? Cost. Revenue should be recognized only to the extent of the contract costs incurred. That is, it is probably will be recovered. Contract costs should be recognized as an expense in the period in which they are incurred. Recognition of expected deficit. According to the standard, construction contract in which it is intended at the inception of the contract that contract costs are to be fully recovered from the property to the construction contract, from the parties to the construction contract, when it is probably, when it is probable that the total contract cost exceed the contract fee. Now, what we are saying here is this. Deficit will come on board as a loss that occur to the contractor in the process whereby the revenue is lesser than the estimated cost. Than the actual cost. That should now be treated as part of what? Expense. Don't let me take you too far. Any deficit occur in the process of carrying out a particular assignment, and at the end of the day, the revenue you have collected is lesser than the cost you incur. The cost is higher than the revenue. In that scenario, you recognize that as part of your expense. That's what you are meant to disclose, disclosure. Now, you are meant to disclose the contract revenue that you have recognized in that particular period. The method used to determine the revenue, you are meant to disclose that. The method used to determine the stage of the contract, you are meant to state that. Those are the things you are meant to disclose. Any entity, an entity should also, at each stage of the contract, in progress at reporting stage, aggregate the costs, aggregate any advances, aggregate any retention fee. All these are meant to be stated clearly. What is the retention fee collected from you? Taking, for instance, it's supposed to give you the total money for the contract. They didn't give you the total money. You were giving 80%. 20% is being hold on to. That is what we call retention fee. The amount of advance collected, you are meant to state that. You disclose that. The retention fee, which is the amount they try to hold on to until you finish the contract and they are satisfied with the contract. That is what we refer to as what? Retention. All these are meant to be disclosed. Now, further to this, standard further stated that entities should present gross amount due from the customer for the contract work as an asset. And the gross amount due to customer, do you know what they are saying? Hello? Is this one? Do you understand what they are saying here? Listen. You have quoted certain amount of money for the particular contract. You are only being given out of the money you have quoted. You are only being given what? 80% of it. That 80%, the 80% will be recognized as an asset to you. The balance will also be taken as what? Receivables. That receivable will be liability to the person that gave you the contract, the contractee. Is an asset to the contractor. But anywhere you yourself, you have a customer that you gave out a work to, that you have yet to pay the person, it will serve as a liability to you, an asset to the person. That is the aspect of the what? Gross amount due from the customer for contract. It's an asset. Why the gross amount due to customer for contract work is meant to be part of what? Liability. I don't know whether you understand what we're talking about there. Between me and you gave work to me, and the work is what? 20 million. Out of 20 million, you pay me 15 million. That 15 million is an asset to me. The remaining balance is also an asset to me if I've done the work you gave me and you are satisfied. Why it is liability to you. But if you have paid me the total money, but I'm yet to finish the assignment, it's a liability to me. Do you understand it? Yes. If I venture, you pay me the total money and I'm here to finish the work. If I'm reporting at that stage, I'm meant to report that I'm owing you money because I'm not done with the job, because you have paid me the total money based on the stage of that particular job. Simply means any deferred income is coming on board here. You paid me the work and I'm here to finish that particular job. And it's going to take me 2 years and I've only done 1 year. The remaining 1 year, the remaining amount that covered the remaining 1 year to be taken as liability onto me, which is the contractor is owing the contractee. Who is this Gloria showing herself, plating her here? I don't understand. Okay. That is all about what? Ipsas 11. Ipsas 11 is all about contract. If you have an idea of contract accounts, this will not be an issue to you. The knowledge on contract accounts will be used here. You can see all the terminology I'm talking about is related to contract, which is related to Ipsas 11. Are we together? The next Ipsas is Ipsas 12. This one is all about what? Inventory. Inventory management. What is inventory in this situation? Inventory is recognized as a what? As a current asset item. Current asset item. That is meant to be valued using different words. Inventory valuation method. Is meant to be recognized effects on that particular inventory, either in terms of what? Future value, in terms of present value, the future value, market value, or any amount. They are fair value. All these they can use to value what? Inventory. We have different methods of valuing what? Inventory. In terms of what? First in, first out, last in, first out. We have books of inventory to be recognized. In terms of what? We talked about what we call bin card, store ledger. The bin card is a document of inventory that we normally use to monitor the movement of inventory based on the requisition. Requisition is document of demand or request for the inventory required, either for production or for office use. Store ledger is also a document to be managed by the account officer, monitoring the movement of what? Inventory in terms of the receipts and issues and the remaining balance. We've done this in foundation. It's just an additional thing we are taking into consideration, which is in line with what it's actually. Let's see what the book is talking about here. The standard deals with the value and presentation of inventory in the financial statement. It doesn't depend on what I was saying. In the context of historical costs, the most widely accepted basis on which financial statements are presented, the standard does not deal with inventory accumulated under the long-term construction work. It provides on of cost and its subsequent recognition as an expense incurred. Any right written down to the net realizable value. Simply means we can also value inventory using net realizable value. Net realizable value is different from initial cost, which is the historical cost of what? Of the inventory. They are not the same thing. And it's different from fair value. It's different from the market value. It's different from the future value. This is in line with what? IS2. Now, let's look at it. The content of the standard. What is it all about? What we are meant to look at. Held for sales in ordinary course of business. If you have held inventory for sales, you need to look at it. In the process of production, we need to look at it in that direction. How do you recognize it? To be consumed in the office for production or service in forms of what? Material or supply. All these are what we are meant to look at when you are looking at what? Inventory. Now, without wasting much of our time here, because there is a lot of things to be read. Excuse me. Okay. Inventory can also be goods purchased for resale. That is where we say you head for sales. Inventory can be looking at something you bought it and you want to resell it. That is what we say inventory held for sales. Now, as a retailer, you are going to buy from the manufacturer. You want to sell to the final consumer. That is an example of what we call inventory held for sales. Specifically in the public sector, inventory are comprised of goods purchased or produced by the entity that are distributed to the third party for no charge or for normal charge. In the public sector, government are meant to purchase inventory in terms of what? Stationaries that are meant for consumption, in terms of what? Implement, depending on the ministry that we're referring to. That is why we say it can be used for production, it can be used for resale. Government can produce and sell in terms of electricity. Government are the one producing the electricity, they will distribute. These people, their agency will sell on their behalf and make a returns to the government. In terms of petroleum products, they will extract the crude oil from the ground, they will sell. Afterwards, what do you call it? Refine it, then the crude oil will be offered for what? For sales. All these are the basis in which we can to hold on to what? The inventory. Are we together? Exceptional from the provision for the what? For this. Now, listen. Work in progress arise under the construction work. Financial instruments, biological assets, work in progress of service. All these, they are exception to Ipsas 12. Exception from the work provision for Ipsas 12. All these are exception from Ipsas 12. Those things that are not relating to what Ipsas 12. That's what they are telling you. We can see work in progress as part of assets, which is part of what? Inventory. Only when it is what? Under a contract. Financial instrument is also exempted from what? Ipsas 12. Biological assets is also exempted from Ipsas 12. That is what they are telling us. And work in progress relating to service is also exempted from what? Ipsas 12. Now, Ipsas 12 does not apply the measurement of the following inventory. Producers, inventory of agriculture or forest products. Agricultural produce after harvest and mineral products to the extent that they are measured at net realizable value in line with well-established practice in certain industry. When such inventory are measured at net realizable value, changes in that value are recognized in surplus or deficit in the period of change. Inventory of a common broker trader who measures their inventory at fair value less cost of sales. When such inventory are measured at fair value less cost to sell, changes in that value are recognized in surplus or deficit in period of change. What we are saying here is this. When we talk of the biological assets, they normally value their product at net realizable value. This is exception to Ipsas 12. What we are looking at is what you buy and you are selling, what you produce and you are selling immediately. Now, measurements. What are the measurements to be taken into consideration when it comes to inventory? Inventory should be measured at lower of cost or net realizable value. There's no doubt about it. Except where Ipsas 12 apply, inventory should be measured at lower of cost or current replacement price at the market. That is when I made mention of the market price that time. Now, in this scenario, we have what we call distribution at no charges or normal charge. To charge that. Consumption in the production process at goods to be distributed at no cost or at normal charges in line with Ipsas 12. When you consume it, we assume that those product has already been purchased and that the cost attached to that. You look at the quantity, then it could be at charges, it could be at no charge, depending on the ministry where you are operating. What are the costs to be recognized when it comes to what? Inventory. We have what? All costs of what? Purchases. Cost of what? Conversion. We are meant to recognize that. Other costs incurred in bringing the inventory to the present location, such as transportation costs, will also be recognized. Now, cost of purchase in case of what? In foreign products. We have the cost of the what? The purchase price, the import duties, and other taxes, transportation costs, handling costs, other costs directly attributable to the what? To the acquisition of the finished goods, material or supply. All these are meant to be recognized. And how do we look at what? Conversion costs in this scenario? We have the direct cost plus shift production overhead plus variable production overhead plus other costs. That gives us what? Conversion costs. Those who pass through the foundation, they will understand this under what? Process cost. This will be what? Cleared under process cost. Now, let's analyze it. When we say conversion cost, the conversion cost is the cost you incur in the process of converting the raw material to finished or semi-finished goods. The cost of conversion of inventory includes costs directly related to the units of production, such as what? Direct labor, systematic allocation of fixed and variable overhead. All these are direct costs in terms of production costs. When we say direct cost under normal circumstances, we have the material, we have the labor, and we have variable overhead. Any fixed overhead is that one is indirect cost. That is what they explain here. This production overhead are those indirect costs of production that remain relatively constant regardless of the volumes of the production. That it is fixed in nature. It does not depend on the units you have produced, such as what? Depreciation, maintenance costs, maintenance of building, maintenance of equipment. All those ones, they are fixed in nature. On the other hand, variable overhead are those indirect costs of production that are nearly directly with the volumes of the unit. This one still depends on the unit of what you have produced. In this scenario, we have what we call normal loss, we have what we call abnormal loss, administrative charges, all those ones, selling costs, those ones, they are exceptional costs from the cost of inventory, exceptional to the cost of what? Inventory. When it is abnormal loss, loss of some materials or labor in the process, in the storage, in your storage what? Facilities, then those ones, they are what? Exceptional, the production unit. But there's a way we factor that into production when we are looking into it statistically. Cost of material or service provider. Now, service provider based on the labor you have what attained to, that you have employed to work for you. Now, cost of inventory of a service provider consists of the primarily of the labor and the cost engaged in providing the service, which is what I did mention of. That is the labor you have charged to work for you, and you are meant to add your own element of that. The cost of labor not included in the service providing service are not included. The cost of labor not engaged. If you don't engage it, don't include it as part of your cost of service. That is what they are telling me. Now, they gave you the what? Formula for what and what when it comes to valuation. This is valuation system. How do we formula we are referring to in public sector refer to what? The inventory valuation. How do we value what? Inventory in the public sector? We have what we call people, we have what we call average. People weighted average. These are the two methods of valuing what? Inventory. Let's look at what it's saying here. We're told here that when applying Ipsas 12, an entity should use same cost formula for all inventory having similar nature used to the entity. All these, they are just English. What you just need to notice here is that you are meant to value your inventory using two methods: weighted average method and first in first out, which is people. First come, first serve basis. That why weighted, regardless of the quantity and the price, you are meant to add everything together, add the cost together to determine the cost of taking it out. On the last part here, we have what we call net realizable value. The net realizable value is the value to be recognized, taking into consideration the sales minus what? Selling expense. Sales minus selling expense. This is the estimated selling price in the original cost of the operation, less the cost, estimated cost of what? Completion and estimated cost necessary to make the sales exchange or distribution when you are valuing stock, you want to value at net realizable value. And if you are meant to value inventory, set the value inventory at lower of what? Lower of net realizable value. In case there is a change in future, do not affect what you have reported. That is how to report in the public sector and also non-public sector. That is under what? Ipsas 12. The Ipsas 13 is about lease contract. Under the lease contract is an agreement between two parties, lessee and lessor. It's an agreement between what two parties, lessee and lessor. This particular party, they have an agreement that they want to make use of their property by one another. The lessor is the owner of the property. The lessee is the one that wanted to make use of the property on an agreed amount in the future. In summary, we have majorly two types of what? Lessee. We have operating lease. Sorry, we have two types of lease. We have operating lease and we have finance lease. According to Ipsas 13, we have operating lease. We have what we call what? Finance lease. The operating lease is the lease that attributable the liability, the risk, the maintenance, and the benefits to the lessor. The benefit of the property to the lessor. And the ownership of the property is not transferable at the end of the contract. That is operating lease. It has some characteristics. When we look at it from under operating lease, one of the characteristics under the what operating says what? The liability is attributable to lessee. 2, the benefit is attributable to what? The liability is attributable to lessor. The benefit is attributable to lessor. The risk of the property is attributable to lessor. Maintenance cost of the property is attributable to lessor. The lease payment is meant to be what? Expense. Lease payment is meant to be expense. The ownership is not transferred at the end of the contract under what? Under operating lease. While finance lease is another form of lease in which the benefit, the risk of the asset, and the maintenance cost of the asset is attributable to lessee, not lessor. Looking at this one, the ownership, possibility of ownership being transferred at the end of the contract is very high as one of the characteristics. Transferring of ownership at the end of the contract is very high under what? Finance lease. The lease payment is meant to be capitalized under finance lease, taking into account the interest rate. The liability is attributable to lessee. The benefit of the property is also attributable to lessee. Maintenance cost is attributable to lessee. The asset economic benefit is attributable to lessee. All these are summary of what we called under what? Under this under what we call lease. But let's take our time to run through all this. It won't be something that you don't have the full knowledge of. I've done the summary of it, but you need to have an idea of what it is all about before we call it today. Even though I couldn't finish, but I want to discuss Ipsas 17 also. But I don't think I can discuss Ipsas 17 here. Now, looking at Ipsas 13 here also, the aims of this standard is formulated to prescribe the lessee and lessor, the appropriate accounting policy disclosure to apply in relation to finance and operating lease. Different from what I've explained. The following definition, the following are some of the definitions provided by the standard. 1. A. Commencement of the lease term. Lease term. In the date from which the lessee is entitled to the exercise its right to use the leased assets. We are looking at what the commencement date. What is the date you are commencing? The initial recognition of the date of that particular lease agreement. We also have what? Content rent. That is the portion of the lease payment that is fixed in amount, but is based on the future amount of the factor that changes other than the passage of time. That is, there's an agreement between two of us that this is what we're going to be paid monthly or yearly. But in the future, subject to change, if there is any change in the process, certain percentage can come on board. And that should also be taken as a future sale to the owner of the property. Finance lease. This is a lease that transfers the substantially all the risk and the reward, which is what I've made mention of, incidental to the ownership of the asset. Title may or may not eventually be transferred, but it's possible under what? The ownership of the asset being transferred. Possible. We are not saying it's compulsory. Possible that the asset can be transferred to the lessor. I mean, from the lessee, from the lessor to the lessee. Under what? Finance. Now, gross inventory. I mean, gross investment in lease aggregate. The amount lease payments received by the lessor under the finance lease. That is what they call the gross amount. That is the minimum lease payment receivable. The amount you are paying, that is what we call the minimum. Amount you are paying for that lease agreement. It is the what? It is receivable to lessor, but payable to lessee. Receivable to lessor, but payable to lessee. Please take note. Any unguaranteed residual value accruing to the lessor, guaranteed residual value is for a lessee. The residual value is the remaining balance of the asset at the end of the day, is attributable to what? To lessee. Depending if it is finance, it might go to what? To lessee. If it is what? Operating, it will go to what? Lessor. Now, let's look at what they are saying here. For a lease, that's part of the residual value that's guaranteed by the lessee or by a party related to the lessee. The amount of the guarantee being the maximum amount that could, in any event, become payable. So that part of the residual value that is guaranteed by the lessee or by the third party unrelated to the lessor that is financially capable of discharging the obligation under the guarantee. Now, in a simple analysis, for operating, it is attributable to what? To the lessor. For finance, it is attributable to what? Under that. Now, let's look at it from here. Initial direct costs are incremental costs that are directly attributable to negotiating and a lease, except for such costs incurred by manufacturer, or all these are just mainly what you don't need to have idea of, but not necessary. We have what we call interest rates. Now, the interest rate, depending on what you are paying, you're supposed to pay as cash and what you are now paying at the end of the day on the lease. But we are going to do that in calculation for you to have a better understanding of that. Now, we have A, minimum lease payment. B, we have what we call unguaranteed residual value to be equal to the sum of the fair value agreement and the initial cost of that. That is, something is being added, saying that in the future, this is the balance on that particular asset. This is what is accrued on it. But all this just need to have idea, but it's not necessary. Don't waste your time. Go to where what and what you need to know. Classes of what? Classification. You can read other ones later on your own. But you need to have an idea of what is what operating lease, which is part of what I was saying before. Now, look at it. A lease is classified as finance lease if the transfer of substantial of all the risk and the reward initial to the owner, initial, incidental to the ownership. A lease classified if it does not transfer substantial of all the risk and reward to the owner. This might not be clear to you. Are you with me? This might not be clear to you the way it should be. Now, listen, when we talk of the finance lease, which is part of what I've made mention of, I said the ownership, the risk, the benefit is attributable to the owner of that asset, which possibly to be the owner at the end of the contract, which is what? The sum. Why, when it comes to what? Operating lease, the ownership of that thing is not transferable at all. It belongs to the owner, which is what? Lessor. All these are what you have here, which is part of what I've explained initially on this part. You also need to have idea of all this. Now, what are meant to be disclosed under are also stated here. The carrying amounts will be disclosed. Reconciliation between the total future minimum lease payment and the report date of their present value. All these are also meant to be stated in details. What we call the payment of operating is how does it go? All what I've explained are also what here under the operating lease. But all what I'm meant to say here might not be clear to you until I try to come up with a practical figure of this to differentiate between the finance and operating what is and how it means to be what treated in financial statement. Now look at it. Lease in the statement of finance, in the financial statement of what lessor, finance lease. Lessor shall recognize lease payment receivable under the what finance lease. In their statement of financial position, they shall present such assets as receivable as an amount equal to the net investment in the. What are we talking about? Amount that you have paid. You are the one that leases the property to me, and I've paid you social amount as a finance lease. I've paid you social amount up to a certain amount. The remaining balance is an asset to for liability to me. At my own end as a lessor, as a lessee, it's going to be liability, which is going to be payable. But at your own end, it's going to be at what receivable. Because you are still what? Until I pay the final payment, the asset now becomes my own. You can try to read all this one up as the characteristics of them. But the time is not permitting us anymore to look forward on this. Ipsas 14, event afterwards reporting. For now, you might ignore that one. You still need to discuss Ipsas 17. That one is very important. There's no way I can do that without recognizing that one, which is part of what I will discuss next class. This is almost to 7, and I need to go and put. I will stop now. I will look into Ipsas 17 next class. Paul, I will now go back to where I'm supposed to think. Paul, I will come back to. Thank you very much.
Thank you very much, Mr. Wasim.
By the grace
you,
of
sir.
God,
Thank you.
next week we are going to see. We can look at the calculation part. Immediately I'm done with Ipsas 17. I will discuss the calculation of all what I've explained on the platform. Thank you very much. God be with you all.
Thank
Thank
you.
you, sir.
Good night.
Bye.
Thank you, sir.
You're welcome.